Good morning, everybody. This is the live market open of Tuesday, November 10th. I'm Yohay, Elam, Forex Crunch and Market Movers podcast, doing the show for FX Read as usual. I'm back after a long weekend. I hope everybody's doing great. And as always, we'll talk today about recent developments, charts and levels, the next 24 hours, and of course, your questions. So you're all welcome to present your questions at the chat box, and if you can't see it, the address is right here below, tlk.io/fxstreet-forex-live-video. Okay, so yesterday was relatively calm. Let's move back to Friday, the big event, and that rocked market. As always, non-farm payrolls is the king of Forex trading, and this time it was special because we had a big positive surprise, so it's good news all around, especially for dollar bulls, but in general for the US economy. The US economy gained 271,000 jobs, much better than around 180 that was expected. Perhaps more importantly, wages finally broke out of range, okay? We had this range of 1.9 to 2.3. Now we have 2.5 year over year, and month over month it's 0.4. Other news, real unemployment rate fell below 10%. For the first time in 5.5 years to 9.8, and revisions were a bit positive. In previous months, we had negative revisions. So what did we have? A stronger dollar across the board. We'll talk about the chart soon. But then we had a little, lots of calm, lots of consolidation. We're waiting for reactions. We had a few reactions from the Fed. For instance, Charles Evans, a big dove. He's the president of the Chicago Fed. Usually talks about waiting and seeing. This time he seems to accept a rate hike coming soon. According to bond markets, it's around 70%. Is that all? It's not. To me, it seems that there's a higher probability and it's not priced in. So let's, before talking about other events, let's see the charts, of course, and then comment on this as well. Good morning, Fabian. Thanks for your comment. Missed you on Friday and Monday. Good to have you back. Yeah, everything is well. Yeah, I had a vacation, so for good reasons I wasn't here. Now I'm back and waiting for your question and for other questions. So let's start, of course, with euro dollar. So we had euro dollar trading in this range, keeping a safe distance above 108.10. which was the July 20th low, if you remember. And then, boom, making this break all the way down to the next support line, 107.10. It remains support. Resistance now is not 108.10 because we haven't reached that level, but more something like 107.90, which was the high. Okay, so we had a big crash in the immediate reaction. Then we had this sort of dead cat bounce. On Monday, yesterday, we had more of a bounce, but it's still very limited, okay? So we didn't see the pair go too far. Okay, so let's look at the bigger picture to see the next levels. So yeah, we had the break under this 108.10, which was the July 20th low. Now we're at levels back is seen only in the spring. Okay, so this is why 107.10 is important. It was support back in March, and then we have 106.60. followed by 105.30, and then of course critical support 104.60, the 12-year low. Good morning, Sarab. Good morning, JM. Good to be back. Looking forward to your questions. Okay, so that was a big reaction on euro dollar, but then it stopped. Pound dollar was already hit by the Bank of England. On Thursday, we talked about expectations for the BOE. It was a very surprising move. Contrary to what we talked on Thursday, they went to the dovish side. Thanks, Malcolm. Good to be here as well. They went towards the dovish side, and they pushed the pair below 153. And then we had a continuation with the non-farm payrolls. We had a fall all the way to 150.30. Okay, but since then we had some recovery. I still think the Bank of England went too far with its forecast. The economy is doing well. In the United Kingdom, wages are rising, retail sales are looking good, consumers are buying, and inflation is a bit low, but I believe it'll stabilize. Anyway, we do have a more significant bounce in pound dollar than in euro dollar. Okay, so 155, 151 is the current level. 150, 160, I would say, is resistance, and 150, well, of course, the raw number of 150 is support. I think we can have some kind of recovery, but let's wait and see. But it was hit by the Bank of England and then by the non-farm payrolls. Okay. Dollar yen, it made a nice breakout. I finally can stop talking about the pair hugging the 120 level because we're at much higher ground. It's supported here at 123, 123.50 or 123.60 is resistance. Okay. So right here, higher range, of course, the high level above is 125. Dollar CAD, see the question. Yeah, we'll reach all these currency pairs throughout. Dollar CAD. In Canada, we actually also had a good jobs report. We had a gain of 44,000 jobs, a drop of the unemployment, or better than expected unemployment rate, 7%. But two caveats here. First of all, of course, we had the non-farm payrolls released at exactly the same time. So the stronger US dollar beat the stronger Canadian dollar, and the stronger NFP beat the good jobs report in Canada, and all in all, dollar CAD went up. So currently 132.73, struggling there with just around 133. Of course, high resistance above is 134.60, the 11-year high for the pair, 11-year low for the Canadian dollar against the US dollar, support at 132.40. But there's also another reason why the Canadian dollar is weakening. Well, two even. Of course, oil prices, but more importantly, the good jobs report that we had on Friday from Canada was partly due to temporary jobs related to the elections. Okay, we had elections in Canada. We had we have a new government there. Anyway, the government hired workers to do some temporary jobs towards the elections. Many of these gains were temporary jobs. We'll have to see if that falls back down next month. So it's not all good news. That's why the excellent jobs report from Canada is not so excellent, and the non-farm payrolls beat the Canadian jobs report. Okay, so jobs weakening. Okay, so Aussie dollar also here, we had a big fall on Friday because of the excellent NFP. In the United States, we fell under 70.65, which was support back here, and now the pair is consolidating in lower ground, still shy of the 70 level, the round 70 number, but 70.65 is turning into nice resistance. Okay, so we have nice technical levels that are working here in Aussie dollar. Now let's move. Talk about a few Aussie-related figures, because that's what we did have. So we had weak Chinese exports, weak Chinese imports, a drop of around 18% in Australia and Chinese imports. That's bad news for Australia. Now tonight we had a fall in Chinese CPI. Okay, we had CPI month over month in China falling by 0.3%. So that's it's right here. Yeah, this figure, this was quite a negative surprise for China. Producer prices are 5.9 lower year over year. That's huge. And also the consumer price index is 1.3%. That is another sign of slowdown, another sign of weakness, in my opinion, for China and for the Australian dollar. Also, the Australian business confidence, which you can see here, jumped from 5 to 2 points. Another bad sign. All in all, I see the Australian dollar is quite vulnerable. I believe that, okay, we might see it attempt to break 70.65, but I don't think we'll reach the next resistance line of 71.10, and we could see the pair fall all the way to 70, and below that we have the double bottom here of 69.35. So I see lots of good reasons for the Aussie to be vulnerable. Okay, Kiwi dollar, to answer your question, Sarab. Well, we had last week two bad news for New Zealand. First of all, milk prices fell for the second time in a row from they fell 7.4%, and the jobs report, which is released only once per quarter in New Zealand, it showed a drop of 0.4% in employment. The economy in New Zealand is still doing well, but it's not as good as it used to be. And now, of course, the prospects for more rate cuts, for a weaker Kiwi are here. Support at 64.75, resistance at 66.15, which used to be support and now turns into resistance. But perhaps we can add another line right here. Actually modify, okay. Well, let's move a few lines here. So the current range is 65 to 65.80, I would say, something like that. It's the current range for Kiwi dollar. It's trading in really nice steps here. After the breakdown from the previous range, it settled in lower range. Very nice technical behavior for Kiwi dollar. Okay, let's jump to pound CAD to answer your question, Sarap. I have it right here somewhere. Should have it, yeah. So here we are at 200.50. We had a dip below the 2 level. So all in all, we have a weaker pound against the Canadian dollar. And that's because of the Bank of England on Thursday, which was a big surprise to me. Well, not only to me, we saw the reaction on the charts. So the Canadian dollar is weaker because of oil and jobs report that had its caveat despite the good number. But the Bank of England hit the pound very hard. We've seen that reaction, a negative reaction from the pound also against the yen, also against the euro. What Bank of England, we had it. Let's talk about that a bit more now. Bank of England decided to leave, of course, the rates unchanged at 0.5%. That was no surprise. The second thing we had is the MPC meeting minutes. They voted 8-1, like this previous decision. No change. Still one member, Ian McCafferty, voting for a rate hike. I thought it would be like this. And then they released also the inflation report. It's a quarterly report in which they stretched the inflation target 3 years to 3 years instead of 2 years, and they lowered the forecast for inflation. This feature, which wasn't expected because wages are rising in the UK, hit the pound hard, really across the board. So I think it's a bit exaggerated because wages, as I said a few times, wages are rising, and the Fed, after the Fed hikes, and now seems a bit more probable, I believe the Bank of England will hike as well. So I think the pound went a bit too far. Of course, there are many different opinions about that. We'll have to wait and see. That was a big event on Thursday. It was indeed Super Thursday. I hope you watched our live coverage on FX Street with Valeria and Mauricio. So it was a big event. I'm happy to see that we had in the past these events by the Bank of England were quite boring, and it's not boring anymore, even though it didn't go in the direction that I thought it would go. Okay, let's go back to the charts, to what we have prepared for you. Good morning, Rob. Yeah, I'm also glad to be back. Let's see what else we have here in terms of events and news. So we talked about Canada, weak Chinese reports, ECB getting closer to a rate cut, sorry. Okay, so we had some leaks, some news from the European Central Bank. According to reports by Reuters, Draghi and his colleagues are getting closer to cutting the negative deposit rate. It's already at negative, it's already at minus 0.20. Just a second. And now there's talk they'll cut it, but to 0.3 or even 0.4, 0.5. In Denmark and Switzerland, the negative deposit rate is 0.75, minus 0.75, much deeper. and these economies are not collapsing. Everything is working. People are not stashing money in the mattress, because that's the problem with the negative deposit rate, that at some point you're punished so much by the bank just to hold the money at the bank that why would you do that? Of course, there's always risk of holding money at home, but so far people want to keep the money in the bank, so there's more room for that. There seems to be more consensus about that than on QE. And that hurt the euro just a bit yesterday. I'll show you this dip here on the chart. But it really didn't go too far. So when we had this news out of Reuters breaking out, we had this fall, okay, from around 107.70 to 107.25, but then it went back into range, okay? I think the better reason for going short on euro dollar, of course, the ECB is in the background, but bigger reason is because of the strength of the dollar, because of the rate hike expectations, the fact that also the doves in the Fed are accepting a rate hike. So currently, if we look at rate hike expectations, they rose from about 50-50 to 67-33, sort of 2/3, 1/3. I think it should be higher because the Fed really seems to get closer, and also the dollar should be stronger, okay? But talked about the ECB. What do we have today? We talked about Australian business confidence, weaker, Chinese CPI disappointing, French industrial output, not that important, but still has some kind of impact, provides us with some data. So let's see if we have it here. Yeah, it was as expected, 0.1%, no surprises. Later today, we have Evans talking. Well, I didn't see anything new. And later today, let's see what we have on the agenda. Questions are welcome, of course. Today is still a relatively light day, okay? We don't have the big events that we had last week, not on Friday. Tomorrow is much busier. And then Thursday and Friday are also very interesting. But today we still have things that could move the markets. We have import prices from the United States, and it's expected to be negative, as you know, because commodity prices are falling. I don't have the forecasts right here, but import price index, no. It was negative last time. It'll probably be negative this time as well. As I said, not that important. At 8 GMT, we have the RBNZ financial stability report. So for Sirab that you asked about the Kiwi dollar, that's a big event because it's not only financial stability, but also they're going to talk about inflation, growth, employment, things like that, and that could move. I think they'll take the opportunity to try to push down the Kiwi. I'm not sure, but of course that's an option. And then early tomorrow, before we wake up, or some of us at least, we have Chinese industrial output, another big figure from China. Expectations there stand on, well, it's not only that actually. So industrial output is the main event. Last time it rose 5.7 year-over-year, which is quite weak, less than the growth rate in China, which stands on 6.9%. So it'll be interesting to see if it falls further. As you see, it's sort of hovering around low levels. Let's see if it falls, but it's not the only number released from China. We have also retail sales, which were quite impressive actually last time, 10.9% growth year-over-year. And we have urban investment, all kinds of figures. It's of course really, really important for the Australian dollar, which, and this maybe could push, if it's weak, it could push Aussie dollar below the round 70 number. If it's good, perhaps 71.10 could be challenged once again if it doesn't happen earlier. So that's the big event for actually today, for the next 24 hours, okay? Let's see what else we have this week. So tomorrow we have the employment data in the UK. Employment is going up in general. It's a bit slowing, but still looking good. What's important to look at is, of course, wages. There are two figures, one with bonuses and one without. We'll talk about that more in detail tomorrow before the show. So, but just to have a look, Last time it rose 3% year over year, which is better than now the excellent figure in the United States of 2.5%. Okay, and excluding bonuses, we had 2.8, which is very similar, also strong. And you can see here on the chart, it's trending higher. Okay, both figures. Let's look at this one again. Sorry, right here, trending higher. Okay, back to pre-recession levels, the highest since the crisis. So I think it's all looks positive for the UK. What else do we have tomorrow? Mario Draghi. Speaking last week, he talked about more action, weighed on the euro. He'll probably do that again this time. Let's see how. He doesn't always talk about monetary policy, but when he does, he usually makes an effort to push down the euro. Let's see if he does. Let's see if he succeeds. On Thursday, we have Australian employment data. In general, it's a really important week for Australia. We have all these figures from China and important Australian figures. And we have on Thursday, Draghi once again, and also Yellen, the chair of the Federal Reserve, talking. So it's a really important day for euro dollar Thursday. Okay. And on Friday, we have Eurozone GDP. It's the first release, and usually there are no big revisions. So let's see, Spain is growing nicely, but Italy, France, and Germany are a bit more vulnerable. These are the countries to watch. The German GDP is the most important one. We have first numbers from France, then Germany, then Italy, and finally the all European figures. Then we have, of course, US retail sales. Critical figure because retail sales badly disappointed last time. It's a huge part of the US economy. These are figures for October, just before the sales season of Black Friday, Thanksgiving, and Christmas, and consumer sentiment, which is already for November. So it's also very interesting to see if sentiment shows us that people are going to go crazy on Black Friday or not. And of course, that's critical for the US economy. See a question from EDZFX. Negative rates affect the consumer bank accounts, as I can see in Europe. Banks are not yet charging retail customers with current accounts. Yeah, I think it's a bit hard for a commercial bank to attract customers if you punish them for keeping the money in the account. Okay. If you tell them, here, you can save some money with us and we'll give you less money at the end. So most banks just have near zero interest rates. I mean, you can save money at the bank and you'll get very, very little. What we are seeing from banks, the other side of that, I feel personally, is that if you have a mortgage, at least here in Spain, or other mortgages that or loans in general, banks are much more general with loans and much more willing to provide loans because they have cheap money. Interest rates are lower, and mortgages, especially those related to the Euribor, are just falling because Euribor is now around 10 basis points. It used to be half a basis point, and it was around 5%. Sorry, it was 50 basis points, 0.5%, and before the crisis it was around 5%. So if people have the renewal of the mortgage and they just pay less every month or every year whenever they have this renewal. So this is a transmission mechanism of the lower rates to consumers, but negative rates are currently not affecting consumers. Another question we have about the charts. Let's get back to the screen. We have a question from Paul. Hi, Paul. Good to see you again. Where do you think euro dollar may retrace after the NFP fall? I'm looking at 108, 108.25, 109, 110.10, from which to short to 105.7, and then parity year end. Okay, most popular pair. Yeah, I'm looking at 108.10 because that was the July 20th low. So currently the post NFP high is only 107.90, but let's say 108. Let's say even this low right here, which was 108.30. So this is more or less the range. So I could agree with you on 108.25. I'm not sure we'll go much higher than that. It's still all the factors things that happened after the NFP, all of them point to lower ground. So perhaps if you wait until 109 or 110, it may be too late. Of course, that's my opinion, not trading advice, but just I'll mention it once again. We had reactions from the Fed to the NFP. They were all welcoming, and the doves, not only Evans, also Rosengren, they were talking about sort of accepting that a rate hike is coming. Okay, so that's one thing to look at. Another thing is that the ECB, they're sort of continuing their discussion, pushing forward, and getting closer to deciding on a rate cut. So if we look at the charts, yeah, 109, 110 are resistance levels, but we have to have really good news from Europe and really bad news from the US to get there. Of course, this can happen on Friday with retail sales. We had enough disappointments from there, but I see a good chance that after this kind of dead cat bounce, big fall, very shallow bounce, will have another fall. My levels to the downside, 106.60, and then yeah, 105.30 and 104.60. Regarding parity, I'm not sure we'll get there. Why? Because we had too many false breaks with the euro dollar. In theory, the break, if we have a break below 104.60, the road to parity is open because we're back to levels last seen in 2003. Okay, of course we can find there's some lines of support and resistance, lines of support in this case, but the road is open. But I'm not sure we'll get there. It's still quite a lot of pips, and quite a lot of buyers could appear at lower levels, 102, 103. We did have false breaks, so I'm not sure that'll happen. Of course, once we break 104.60, we'll talk again. Perhaps the circumstances will justify that. But in general, I don't. So to conclude, I see a good chance that we won't have a much bigger bounce than current levels. Let's see, 108.25 seems to me the top. And then we could have a fall, but not all the way to parity. Okay, another question. Is this a global market putting a gun onto the US and trying to force a hike? No, Jax. I don't think some might want the Fed to hike to get over, in the sense that they want, because there's a lot of uncertainty. Uncertainty is bad for markets, and they want to get it done with, get over. But this isn't exactly. But some are very afraid of a rate hike, so they don't really want that. They want the Fed to shut the whole thing down, forget about it. So I think the Fed, it's mostly the Fed created the expectations on the October 28th meeting. They were relatively hawkish. They saw improvement in employment. They weren't worried about inflation, and they talked about the next meeting. And then we had the excellent NFP. So I think we have the Fed lifting rate hike expectations, then NFP reinforcing that, and then responses to the NFP from the Fed have also pushed it higher. Okay. Another question from Fabian. Yesterday, New York opened with the fall in S&P and in the dollar, so euro dollar bounced up. Any idea why that happened? Actually, no. I think it was all the moves yesterday were relatively shallow. We didn't have too much news yesterday, not earnings, and not in the stock markets, I mean, and not too many economic indicators. So I don't really have. I think it's just the ebbs and flows of markets. We have, things go up and down. The ranges were limited. We didn't have any really striking move over there. Okay. Let's see what else. Let's talk about other charts. Of course, more questions are welcome. Euro dollar. Let's talk about dollar Swiss. We had a break above parity there. Yeah, one nose is 1032. Next resistance that I have here is 101.50, because that was the level seen back in March. Okay, and then above it we have right here 102.50. So these are the next levels to watch. Parity provides support, and then we have 99.50. Let's move these lines. Right here, and yeah, more or less. Anyway, I wouldn't trade the Swiss too much because we have intervention there by the Swiss National Bank. We've seen the fall of euro-dollar supported, received a bid afterwards from the Swiss National Bank. We're here at 107.50 as support, resistance at 108.40 more or less. Another question before we move to the next chart. Hike is not necessarily good for the US economy, but it seems to the rest of the world is almost demanding it. A hike in the US economy shouldn't hurt the economy too much because it's still growing. Jobs are rising, wages are rising, as we've seen on Friday. And I think that another rise of 25 basis points, especially as the Fed said so many times that it's going to be gradual and not going to, not beginning a tightening cycle, which will be too strong, is not really critical. So the IMF, for instance, is not demanding it. Emerging markets, on one hand, are afraid what will happen with capital outflows, but on the other hand, they're also worried about, but also want to get over with the uncertainty, so it's not clear-cut there. Another question from Malcolm, very basic question. What would be the effect of rate hike on the dollar? Will it strengthen or weaken majors and minors and DM? Thanks. Yeah, important question. I think that the first reaction to a rate hike will be dollar positive across the board. No prisoners taken. Stronger US dollar against the euro, pound, yen, Aussie, Kiwi, CAD, Swiss, everything. Emerging markets currencies as well, everything. Because the market still doesn't really believe that the Fed is going to hike rates for the first time after 9 years. Okay, so that'll be positive. Now, what we know from the past is after the fact, we have a sort of buy the rumor, sell the fact. Not immediate move, not an immediate one, but I would say a few weeks or perhaps 1 month afterwards, once we have the uncertainty over, once we have one rate hike, and then markets will begin believing the Fed that the Fed will not raise rates very quickly for a second time. So that's, I believe that then the dollar could change direction against everybody, especially against the pound, because people will expect a rate hike in the UK as well, but also against other currencies. Which ones can benefit more than others? When we'll reach that bridge, we'll talk about that. But the instant reaction is a stronger US dollar, then perhaps a reversal, with the pound perhaps being able to reap the best benefits. Another question. My view on gold is that it has to drop to a lot lower, so central banks like in the EU and France can buy gold. They don't have to return to Germany. France owes 420 tons to Germany, so it's central bank collusion to drop gold below 1,000. That's one of my reasons. I have more, but what's your take on gold overall? Agree with my point? Yeah, let's look at the chart of gold. I don't think there are other reasons for gold that I see. Let's move back to the charts right here. Yeah, gold 1091 at the moment. We had a big fall from 1182. Support is getting closer. 1070, that was the low seen in the summer. So we had quite a big fall in the price of gold, quite a gradual one. I think that it's mostly because of the Fed. Higher rates mean less demand for gold. It has a bigger impact than what's going on between France and Germany. I'm not really aware of those. The France owes Germany gold. I know that Germany repatriated some of its gold that was in the United States. But in any case, if the Fed will indeed hike, it'll be negative for gold, because gold likes speculative money. But on the other hand, we also have support for gold from the real world. So we have Chinese and Indians and others just using gold for jewelry. There are also some industrial uses. So I don't know if it can really collapse, but so that's my view on gold. Resistance 1100, support 1070. These are the current levels. Jack says temporary jobs. We had local elections here too. Remind me, Jax, where are you situated? Anyway, elections have a temporary impact on jobs. We had, for instance, not only elections, we had in 2010 we had the U.S. Census, and then we had a huge rise in jobs and then a huge fall in jobs that was unrelated to the business cycle. So yeah, Malcolm, thank you. Could you show a pictorial form what you just said, hypothetical course, just to reinforce for me? Sorry for the trouble. I really want to get it properly. What are you referring to? The price of gold? Anyway, or something else? Or emerging markets? Please clarify, I'm not sure. You said the big banks, Jack says, are conspiring to make money. I can't see those honest, hardworking bankers trying to get richer. Yeah. Well, we all want to make money, don't we? But banks have early access to money, and bankers usually decide to pat themselves on the back and thank themselves for the good work, which is sometimes thanks to central banks providing easy money, and so these bankers give themselves nice bonuses. Hopefully they pay taxes for these nice bonuses, so there's no problem there. But it's not always the case, is it? Yeah. Anyway, yeah, let's yeah, Malcolm clarifies regarding a rate hike. Yeah, I can just repeat what I said. I don't have a pictorial form regarding a rate hike. I can show you this chart. This is the CME Group FedWatch tool. Implied probability for rate hike currently stands at 2/3 yes, 1/3 no, which is higher than before, but still not a clear cut, not an overwhelming decision. And January, and the next hike perhaps only in, I would say, April or June. Okay, in general, expectations are relatively low for a rate hike. Once we have that, once the Fed really does this move, which is an earthquake, it's the first time it'll be huge dollar positive. But then the uncertainty will be out of the way, and then perhaps they look, okay, so we had the rate hike, the world didn't collapse. The next rate hike will take only 3 to 6 months. Maybe it's not going to be a real disaster. So maybe there are other better currencies to buy instead of the US dollar. Question from JM. Do you think that the current political situation in Catalonia can have some impact on the euro? Yesterday they declared a new state at the parliament, but I didn't think Rajoy or the new president coming in after elections will be in favor of independence. Well, here I live in Barcelona, Catalonia. Yeah, it was a big day. They didn't really declare independence. They declared a roadmap. I think they're playing tough with the authorities in Madrid towards the elections, improving their negotiating position. Why are they doing that? Of course, well, lots of reasons. They want more autonomy for the language, and they want to manage their own fiscal issues. They do have some valid points, some of them not, but well, it's just political opinions. Anyway, what happened in the past 4 years with the government of Rajoy is that he rejected everything, wasn't willing to talk at all. That just fueled the pro-independence camp. I believe that most Catalans would settle for getting a bit more respect from Spain and managing their fiscal stuff exactly like they do in the Basque Country and Navarra in the north of Spain. And they would not, only a small minority, I believe, really wants independence in any price, okay? But the government has been so tough that many people were just pushed to the pro-independence camp. Now, Yohay and another right-wing new party is called Ciudadanos, which means citizens. So the center-right and the new right, they oppose any concessions to Catalonia. But on the left wing, we have the more softer tone from the socialists, and the new left-wing party, Podemos, which means in Spanish we can, or sort of friends of Syriza in Greece. They say, okay, the Catalans want a referendum, they can have it. And I think it's the correct approach, because what we've seen in Scotland, Scots got a chance to vote. They decided to stay better together, you name it, and it's more or less resolved, at least for now. I believe that if we have, if Catalans get the opportunity to express themselves in a binding referendum, there will be a small majority against independence, and this issue could be settled down. So perhaps they're trying, the Catalan government is trying to improve the position. It can have an impact on the euro if things get worse. Currently, it's like Greece at the moment, not like Greece a few months ago, but like Greece at the moment, that it's a background story more than a real impact on the euro. We have to watch the elections. They're on December 20th. Anything can happen. Usually we had a two-horse race in Spain. The socialist PSOE and the right-wing Partido Popular switching power between one another. Now we have four parties, so it's much more complicated. I believe it can have an impact on the euro. Just before Christmas, low liquidity. We'll talk about that, of course, when we get closer. Yeah, more questions I see here. We have Simon asks, how do you view BCO prices over the holiday season? What do you mean? What is BCO? Sorry, I'm not sure I understand. Many companies have been financing stock buybacks, so a rate hike will affect many companies' earnings. Fed aware that a panic attack can occur in the market. I think markets are well prepared for rate hikes. So yes, companies have been using this money, cheap money, to buy back their stocks, and this, of course, fuels stock prices. And the Fed is certainly aware of that. Everybody's talking about that. But since we had so many preparations, it can hurt the stock market, yes. But at least in the United States, I believe there won't be a crash. Better companies will do better than bad companies. That's clear. But companies that are well managed and make real money, I think they'll be all right in the stock market. So I think the Fed prepared us so much time for this event that I believe we won't have a really big crash, a big panic. Okay. What levels do you think the dollar has to hit in December that the Fed would not hike? I'm not sure the dollar itself can impact the Fed not to raise rates. Yes, the Fed is talking about a stronger dollar as weighing down on inflation. That's right. But on the other hand, we have, but if the economy is doing well and the dollar is strengthening, it's not such a big worry. The US economy is a bit more like a closed economy. So if we have weak data, weak non-farm payrolls, GDP revised down, you name it, then we can have the Fed refraining from a hike, but not on the dollar alone. Okay. Yeah, please post link to CME. Sure, let's do it right now. Here you go. Does the RBNZ want to push down the Kiwi or support it? Push down. Definitely push it down. They've been complaining about the value of the Kiwi many times. In the recent rate decision, they decided not to cut the rates, but they talked a lot about the Kiwi and about readiness to act. So they certainly want a weaker New Zealand dollar. Portugal has a change in government. in your membership, ETC. Yeah, in Portugal, we had a big mess there. We had the biggest party was the right wing, the previous government. They came out as the biggest party, but they didn't have a majority. The left-wing parties had a majority. Initially, the left-wing parties were a bit of a mess between each other, but at the end they decided to form a coalition. Contrary to what the president said, the president is from the right-wing party, and he wants his party to keep on ruling. But in a democracy, if we have a majority in parliament wanting to form another government, there's going to be a change. And this is an anti-austerity government, not as extreme perhaps as we had in Greece, not as outspoken, but Portugal is a small country. They're currently out of the bailout program. They're on the periphery. But once again, this is another story boiling on the fringes, and this could erupt back into the center. So we have Greece, Portugal, and Spain currently on the sidelines, but perhaps not for too long. Okay. Simon says, yeah, I said that again. Simon says, sorry. My apologies. How do you think oil prices will do over the holiday season? Holiday season, it's more before the holiday season. We have an OPEC decision. I believe they'll fall because OPEC members and other world oil producers are not able to agree on production cuts. Perhaps there's less investment and we'll have less production down the line, but at the moment, oil prices, let's look at the charts, are relatively low and production is relatively high. So yeah, this is a WTI oil. We've seen it now, it's around 44, slipping from the highs. I was talking last week that the rise in the price of oil was unjustified. Anyway, 44, support at 42.50, resistance 45. We had a low under 38. I'm not sure we'll get there so fast, but I believe we can have a dip under 40 relatively soon. Okay, well, it's thank you very much for all the questions. It's time to wrap up the show. This is the live market open wrap for Tuesday, November 10th. We have still echoes from the non-farm payrolls. Let's remind everybody what we had: 271,000 jobs gained. Wages broke above resistance at 2.3, reached 2.5 annual rise year over year. Other good figures also supported the US dollar. So we have on euro dollar, big break we had there under support at 108.10, but currently consolidating in the manner of a dead cat bounce. We have similar reactions from other currencies, such as pound dollar, which was also heard by the Bank of England on Thursday. Lower inflation forecasts. Dollar yen made a big break higher, finally left dust behind the 120 level. We're currently 123, resistance at 123.60. Canadian dollar ignored its good jobs report, and for good reasons. It was probably temporary, currently at higher ground. Aussie dollar, I see it as very vulnerable. That's because of weak Chinese data, exports, imports, CPI, PPI, and weak figures from Australia. Currently holding to 70, but could fall towards the double bottom of 69.35, resistance at 71.10. New Zealand dollar stable at 65.20, ahead of the RBNZ in financial stability report. And all in all, I think we have a period of consolidation, but we had a few responses from the Fed. Fed doves like Evans and Rosengren they both seem to accept the rate hike is coming. So I think we currently have rate hike probability about 2/3 against 1/3, 67, 70%. I think it should be higher according to what the Fed says. They think there's more potential for US dollar strength. Today is relatively sort of a slow day in terms of news. Also yesterday was like this. We had a consolidation yesterday. Perhaps today we'll see more action, even though we don't have too much news coming up. Anyway, the events for today, of course, we can have more speak from the ECB because they're talking about getting closer to cutting to have a negative deposit rate. In addition, we have today we have import prices from the United States. financial stability report, and the biggest event for the next 24 hours is the Chinese industrial output. So watch out for the Aussie dollar. It could become quite interesting over there. If we have another weak figure from China, or a bulk of weak figures, we also have retail sales there. Perhaps we can challenge the 70 line. So all in all, we had in recent days lots of movements in markets, and especially on Thursday and Friday, then some consolidation. Let's see if we can end this consolidation and have fresh moves in markets, looking at euro dollar and Aussie dollar in particular. Okay, so that's the show for today. Thank you very much for coming. I'm glad to see all of you back after my short vacation, and looking forward to see you tomorrow with all your questions, and wish you all a happy and successful trading day. So that's it. Thank you, and bye-bye.